Welcome to the show, everyone. It's the Crypto Lark broadcasting to you from New Zealand, and today we're discussing stablecoins. We're going to be breaking down what the most popular ones are, what they do, and why you need stablecoins anyway. All of that and more after a massive thank you to all you guys for continuing to support the channel and for being part of the cryptocurrency community. You do also have to remember, this is not financial advice. This is just a dude talking about cryptocurrencies on the internet. Let's go ahead and jump into this. Why are stablecoins important? The market is notoriously volatile. And a lot of people use stablecoins. That is, by the way, the definition of a stablecoin is something that has a pegged value. For example, a US dollar tether is worth $1 US. And so it always maintains that value, or at least it's supposed to. Many people in the crypto space will use stable coins for hedging. So if they think the market is going to go down, maybe there's just been some bad news out of South Korea, well, it's time to move your crypto assets or a portion of them into a stable coin, wait for the market to go down, buy back in later, beef up on your crypto stack, and then move on. The problem is if you move into a stablecoin and you're wrong about the market and the market goes up, and of course you lose out on a certain amount of your crypto. This is a particularly useful tool for people in places like Venezuela who are trying to survive on crypto. Many of us watching the show are simply speculators or believers in the technology, but you have to realize the real world use cases of cryptocurrencies for people in places like Venezuela, where cryptocurrency mining is very cheap, but they are still susceptible to the volatility of the international market. Now, while it may be a worrying thought or an inconvenience for us to watch our cryptocurrencies dive by 10% or 15% in a week, for someone in Venezuela, that can mean not eating for a week. Stablecoins are also useful in evading quite often draconian capital controls in some of the world's developing countries. And again, they want to have access to dollars or euros or pounds or yen, whatever it might be, but they might not even be able to buy them on the open market. But on a decentralized marketplace that anyone can access, assuming they have the internet, it then becomes possible to at least have the digital version of those currencies. It also lets you have a stable amount of cash, we can say, on hand for buying dips. So it's always a good idea to have some real money on hand in order to take advantage of those dips when they do come by, and they do come by quite frequently in the crypto markets. Now, you may not always be able to get cash into Coinbase or wherever you're buying quick enough or in the amount that you want, so you might just want to have a certain amount sitting on hand at any given time in a stable coin, just waiting for those opportunities to present themselves on exchanges. Speaking of exchanges, many exchanges do not offer real cash money. Now, Coinbase or Gemini, for example, those are exceptions. They deal in real money. That means you put in real money, you can get real money back out. A lot of exchanges do not. Well, recently Binance has announced they're going to be doing the euro by the end of the year. Many cryptocurrency exchanges are using stablecoins, not real money. Of course, you might also look at use cases like payment stability for commerce. This is at least a perceived barrier, if not a real barrier, for many e-commerce and retailers. They might be interested in accepting digital currencies, but they're not actually interested in the volatility of those cryptocurrencies. And look, this is a problem that has been becoming less as more merchant services become available for cryptocurrencies that allow you to cash directly out to fiat, even if you accept Bitcoin, for example. but still, it would be a useful tool for commerce. One other thought too is that while the idea is to have a stable coin be worth $1, for example, scarcity and demand can drive prices much higher at peak times. So it's not always worth $1. Sometimes it's worth more. Sometimes it's worth less as well, even though they do try to keep it within a range. We're going to look at some of those ranges here momentarily. The first stable coin we're going to be looking at today is based on a crypto collateral model, and that is Maker. Essentially, Maker is a 2-token model where we have the DAO tokens, which are the governance, utility, and capitalization tokens, and are also used to pay fees, which are then burned. And then we have the DAI token, which is the stable coin. Now, this whole thing works on a system of collateralized debt positions, currently only working with Ethereum. So if, for example, you wanted to get $1,000 worth of Maker DAI tokens, you would have to put in $1,500 worth of Ethereum in order to properly collateralize. The blockchain model makes this rather transparent, but because of the collateralization, this is still exposed to extreme market events. Even though it is 150% collateralization, we know how the crypto markets can be. They are irrational and highly susceptible to mass volatility, so it can be problematic. You also lack capital efficiency using something like Maker DAI, because you're locking up 150% of your funds while only getting 100% out, so to speak. Looking at the market history of DAI, currently it's a $42 million market cap, so it's 42 million DAI in circulation. However, you can see it's done pretty well at maintaining approximately $1 based on demand. We have had situations like here where we went down well below $1 all the way down to 86 cents, or we have situations where we go well above $1 and we get up to, for example, $1.17. That doesn't sound like $1 to me, although they have been, of course, working to try and make that more stable as time goes on. But even very recently, in the last couple of days, we see events where it's getting up over $1.04, for example. And that may not be a big difference, but when you start talking about tens of thousands of dollars, you may be hedging in and out of the market, that starts to make a difference. Next up, we have Havven. Now, I recently interviewed the guys from Havven. It's a cool project, but essentially we're still working on a crypto collateralization model. Now, in this situation, it's not that we're bringing in an outside asset like Ethereum. We're actually using the Havven tokens themselves. So this is another 2-token system. So the Havven tokens work as the collateral in the network, and they incentivize users to maintain an optimal amount of liquidity by incentivizing the correct issuance of the pegged token, which is the Nomin token. Theoretically, the incentive system will create a virtuous cycle of participation and, of course, rewards, because you get the fees that are paid out from holding the Havven tokens. They have an 80% buffer zone. So if I have 100 Havven tokens, and let's assume that the price of a Havven token is worth $1, well, I'll only get 20 Nomins that I can issue out. So it's a bigger buffer zone than, for example, Maker offers, but still susceptible to extreme market events. But yeah, 80% dive in the market. That doesn't sound like fun at all. Nomins are starting off using the US dollar, but they are planning on reaching out into other currencies here in the near future. Havven currently has a great list of partners, a public team, and a growing interest from exchanges. I do like the idea of these blockchain-based solutions because there's no central authority issuing out the money, right? It's the smart contracts which are issuing out the money, which makes it a trustless system to an extent. Of course, you still have to trust that the market itself will not collapse to a point where the collateral no longer has sufficient value. Now, they really try with Havven in particular to mitigate that situation, but nevertheless, it is still something to consider. And actually, you might even consider that, well, I personally think that the Havven model of having their own token being what's put up to create the Nomins as a more effective model, you still have to realize, though, that Ethereum with Maker is kind of a more valuable piece of collateral to put up. Currently, Havven is only trading as a token. The Nomins are only just being issued, so we don't have any good data on how well Havven has been able to maintain having a $1 token. I would imagine that immediate market premiere will be a little bit rough because there's simply not going to be enough liquidity for these tokens rolling around. The more of them there are, the less susceptible they are to these temporary demand spikes, for example. Next up, we have the real world collateral models. These are highly dependent on trust because essentially what you have is some centralized party issuing out a digital currency based on the promise that they have one of those things that they promise the token represents. We're going to start off by looking at Digix. Now, Digix is another two-token system. We have a DAO token which pays out dividends to the holders and gives them governance rights. However, of particular interest to our conversation today is the DGX token. This represents 1 gram of gold. This is held in custody by Digix. Digix runs on Ethereum. And, well, I really think that gold is an interesting hedge, quite a good hedge actually. You still have the susceptibility, though, to price fluctuations because gold trades against the dollar and gold trades against the euro and against the yen and against the pound. And so it's based on these markets and fluctuates in those markets. So if your end goal is to be holding more US dollars, well, if you hedge out into Digix and the gold markets tank, you kind of run into the same problem again. But if your goal is to be hoarding gold, by the way, Digix can actually deliver you actual gold if you cash your tokens in, which is kind of cool. But it is still a centralized network that relies on an actual physical gold vault sitting in Singapore. That being said, though, Digix does have some really exciting partners. They've been working with quite a few decentralized exchanges like Kyber. So if you have an Ethereum wallet, you can just very easily hedge out of your Ethereum position into Digix tokens and then hopefully, of course, back into Ethereum later if you get it at a cheaper price. There's also a growing level of other high-level partners, too, and they, again, have a very big focus on transparency, but you have to trust them. They are having quarterly audits, but they actually have to have those audits consistently over many years and not stop doing it, like the next guy we're going to talk about. But before we do that, just one quick look at the Digix Gold token. Now, obviously, there's a lot of volatility here because, remember, we're tracking the price of gold per gram. We're not tracking dollars. The interesting thing is, though, currently, a Digix token, $43.81. Currently, the actual price of gold per gram, $41.72. That's interesting. You can see there is a high demand for the tokens, even catching a bit of a premium over the actual price of gold. Okay, it's time to talk about Tether. I've made a whole separate video talking about Tether and some of the allegations behind it, but I'll just give the short version of what Tether is and what Tether does here. Tether is a digital token running on Omni. It is supposed to be backed 1-to-1 for dollars, held in Tether's bank account. And actually, the economics of Tether make good business sense. It's actually a rather viable business model. However, the big problem with Tether is that they promised audits. there has been no public audit anyway, and I'm sure they would make it known if it was, of Tether for about a year. The current verification level of Tether is literally a guy who talked to a guy who said that it was okay. I could, of course, reference my interview with Changpeng Zhao of Binance. He said, well, I didn't see the accounts personally, but I talked to someone who said they saw the accounts and they said it was okay. Does that sound good enough for you? If I was to write on a piece of paper, this is equal to $1 and hand it to you, and you say, well, hey, wait, how do I know you actually have that dollar? It's okay. My friend over here said that he talked to a guy who talked to a guy that said they've got $1. That wouldn't work. You wouldn't trust me. So why do we trust Tether without actual public verification? There's a strong potential that Tether is actually just practicing fractional reserve banking, which is not what they said they were going to do. So that is that they have, for example, $1 billion, but they're actually issuing out $2 billion worth of tokens. So they're issuing out more than they have. They only have a fraction of the reserve in their bank accounts. This is highly possible. Hard to say, though. Tether's got all kinds of dirt behind it. We only found out who the management team was because it was revealed in the Paradise Papers leak. And then when it was revealed, it revealed very close connections to Bitfinex. There have long been allegations of wash trading on Bitfinex, of using Tether to manipulate prices over on Bitfinex. However, US Tether has remained a popular choice for many of the world's biggest exchanges because it's difficult for them to get bank accounts. Cryptocurrency exchanges like Binance use Tether. Huobi uses Tether. It's difficult to get these fiat on-ramps, and due to the current popularity of Tether and the large market cap of Tether and the reliance of many people in the cryptocurrency market on Tether, it presents a systemic risk to the crypto markets. It's also incredibly difficult to actually cash out Tether, which is a whole different problem. Now, how does Tether stand up and actually being worth $1? Well, you can see it's actually pretty decent. We're looking at the 1-year chart here, and overall it has done pretty well, actually only going a couple cents in either direction. The biggest movement here is when it got up to $1.06, but you can look here at the current market, and even though there's a lot of fear and movement and volume, we're actually kind of tracing right around $1. So Tether does win actually when it comes to being the stable coin that actually is worth $1 when it says it's worth $1, or close enough to $1 anyway. The newest big competitor for Tether, TrueUSD by Trust Token. Now, TrueUSD is essentially repeating what Tether is doing, however, they're promising to do it better. So essentially we have a situation of fiat backing, but in a more transparent way. There are open source smart contract for verifiable escrows. You transact directly with the bank. TrueUSD doesn't actually hold your money. It's held by a bank. KYC is necessary to redeem your tokens for hard cash, but they're promising that it is an easier situation to get the cash out. With Tether, it's nearly impossible. There is a growing exchange acceptance for TrueUSD. However, they are still very far away from the wide acceptance of Tether, for example. They've got a growing list of high-level partners, a very public team, which is nice. They've been public from the get-go. They didn't need a whistleblowing event to reveal themselves as being the people behind the company. When I look at TrueUSD, I think it's basically superior in almost every way to Tether, except that it's currently used on far fewer exchanges and lacks the market pairings and the volume that Tether does. But I feel like a lot of the exchanges will start switching to different stablecoins, potentially like True USD, as the suspicions around Tether continue to grow, unless of course we have some revelations from Tether and everything turns out to be okay. But that hasn't actually happened yet. Now, True USD does fail the test, unfortunately, though, at being worth $1. We did see a big speculative run, ironically, on this very recently when it was announced it was going to be listed over on Binance. It got up to $1.31, guys. People were paying $1.31 for $1. That is crazy town. How does this happen? How does this happen? I don't know, but it does. So they've been trying very hard to keep that $1 value. That wasn't their fault. I think it was a lot of people having no idea what it was, but just running out and buying it, pushing the market volume up. And of course, as I mentioned earlier, we do have a situation with many of our stablecoins. They have very low market caps. And that's a problem because there's not a big circulating supply. They've only got $44 million over at True USD. And that is spread across all of these exchanges. It's on Binance, and Bittrex, and Upbit, and Cryptopia. Some of the world's biggest exchanges list True USD. So maybe they've got 10, 20 million each. That's crazy. That's crazy. It's no wonder demand spikes up so much for something like True USD when there is a market run, because there's only a small amount of available. If there were $40 billion of True USD, you wouldn't see this kind of price spike. So it's still very small and still very early days for the guys over at True USD. There are lots of other stablecoins besides the 5 that we mentioned here, but there are a lot. We have Hello Gold as an alternative to Digix, for example. We have the BitUSD, we have Koala, we have Dimcoin, we have 20 other projects that are very small market caps. We have more ICOs coming to do stablecoins. There will not be a place in the market for all of these. There just won't. We actually need a few of these to rise up and be big so they have sufficient liquidity and sufficient volume to actually be worth what they say they're going to be worth. I think that Maker and Digix and True USD, they offer really interesting models, and Havven as well, of course. They're all relevant, they're all transparent models, they all provide a good tool for the crypto economy. Tether has proven the opposite. They've been non-transparent and all these dirty links. It's not good. It's not a good look for the cryptocurrency economy. And it's not good for investors either, because imagine that you do hedge out into Tether and the next day the FBI raids Tether headquarters because of potential fraudulent activities. What do you think is going to happen? Tether, it goes down. Now, look, I'm not a big fan of the over-collateralization models, though. I mean, they're useful and they're better than Tether, I would say. But something like Maker, yeah, it makes sense, but to be honest, I find the other systems to be a little more compelling. Havven's blockchain model is also cool, but I think we really need to see the proof from Havven. Time will tell if they're going to actually be able to maintain an accurate value and maintain the essential liquidity in the market. They're just coming to market. I really like the decentralized nature of Havven and what they're intending to do, but we have to see them prove themselves first. Digix, I'm a big fan of the gold hedging idea. I like that you can do it straight from your wallet using Kyber. That's really nice. But you have to keep it real. Almost nothing anywhere is priced in gold, and it is susceptible to the dollar and euro price fluctuations. So if a downtrend happens for a week and you've hedged out, but what if the gold goes down as well? Makes it a difficult hedge in that situation, unless your end goal, of course, is to have more gold, at which point it's just a fine hedge. Of course, there is a whole different conversation to be had about the idea of hedging into dollars anyway. Dollars just represent something that I know a lot of people in the community don't support and don't want to get behind. Maybe you should go all crypto. Hedge in Bitcoin. Don't hedge in dollars, hedge in Bitcoin. There's a lot of people in the market who do that. look, the dollar has been steadily losing its purchasing power over time, and some people do put that out as an argument against stablecoins, but at the same time, it doesn't happen dramatically. The US dollar and the euro and the pound and the yen are all massive global currencies that have huge power behind them. Even though the dollar has been losing its purchasing power, it's a slow bleed. It's not going to lose 30% overnight. Not like cryptocurrencies. I think True USD, though, is probably the best competitor to Tether among all the ones we've talked about today. But again, let's see those audits continually roll out. Let's see them continue to be transparent. They're starting off on the right foot. Let's see that, of course, continue to move forward. But hey, those are just the two Satoshis of a dude talking about cryptocurrencies on the internet. Thanks so much for watching the video. If this message resonates with you, help grow the community by sharing this video across social media. Thumbs up the video. Let me know what you think about any of these stablecoins in the comment section down below. Join the conversation over on Twitter. Long live the blockchain, and peace out till next time.